Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Ronnie Stoeferle, managing partner of Incrementum AG. Ronnie, thanks for joining us, sir.
Hi, Ivan. Hi, Jim.
Pleasure to have
Hey,
you on.
Ronnie, we just had big momentous news this past week. We just had the FOMC meeting, and Jerome Powell and his merry band of men and women, they decided to do a double taper, sort of accelerate this taper. And we wanted to sort of get, you're a gold expert, you're a gold analyst, market analyst. What's going on with the Fed and how it might affect precious metals?
Yeah, let's do that. They came up with this double taper and or the turbo taper, as I think Morgan Stanley called it. And actually Morgan Stanley, which is always a sales guy at Morgan Stanley once told me bears don't get paid. So they're usually on the bullish side, obviously, but even their research said that this turbo taper will trigger market chaos over the next 3 to 4 months. Now, what happened after the announcement? Everything was bid. We saw that even gold and silver were up significantly. So the Fed actually did exactly what the market has expected and where the Fed fund futures were priced. So they doubled the taper. They I think 10 out of 10 members are now expecting 3 rate hikes in 2022, and 5 members said there will be only 2. Their forecast for 2022 is for inflation is 2.7%, which is up from 2.3% previously.
Mhm.
So even if they get the Fed funds rate up to 1% in 2022, that would still be deeply negative real rates. So from my point of view, I mean, I didn't really see a big hawkish U-turn. It's still very, very dovish. But on the other hand, I'm pretty sure that what we're seeing now is already having massive consequences for the markets, and it is not. I think that's what people forget. It's the flow and not the stock that matters. And
Mhm.
tapering is tightening for markets. It is tightening for the economy, and if we compare this tapering episode with previous ones. First of all, the Fed is tapering twice as fast this time. Then asset prices are much richer today. So the US economy is much more financialized. It's much more dependent on high asset prices, not just with equities, but of course also with housing.
Mhm.
And we are tapering into the weakness. So growth is also already decelerating rather than accelerating. So, I mean, we all know that this rally in markets is quite narrow, and there were good research papers produced, one by Goldman and I think the other one by Morgan Stanley, saying that actually the majority of this bull market in the Nasdaq, but also in the S&P, is basically being taken care of by only 5 stocks. So the
Mhm.
broad market, the broad equity market, doesn't do so well, and I think this is this tightening that we're now seeing um, will end pretty badly. And then, of
Mhm.
course, I mean, it's a confidence game. That the big question is how quickly can they make the U-turn again?
If that happens here, like come February, come March, if they start anticipating the biggest buyer is no longer going to be there supporting, what is the clearing price then? I think that's the
Mhm.
question, right? What's the clearing price to bring enough private investors into the market to buy all these bonds? We've still got a $3 trillion deficit in the United States,
Mhm.
right? I mean, I don't know how they do this.
Yeah, I agree, Jim, but it is a relative game, and what would you guess is the yield for the, let's say, the 25-year Greek bond?
Oh, right now, what is it? 1%, 2%?
Yeah. Yeah, it's one
What,
1.1%.
what would it be?
1.1.
What would it be if
France
the European Central
France
Bank
50
wasn't?
years.
Yeah, France 50
France
years,
50 years is
1.3.
0.8. 0.8.
That's
So
nuts.
Italy, 50 year. I mean, we're seeing a bigger spread here. 50 years, 2.2%. It's still
Jeez.
Wow.
I mean, I think given the fact that the inflation is running hot, that's not the very best investment, to say at least. But on a relative basis, then I would say, if I want to buy bonds, then probably I prefer US 10 years to Greek 10 years.
Hmm.
However, I think that I agree with your point. If the big marginal buyer is going out of the market, it will have an impact in the US, and therefore I'm pretty certain, and we've made this call previously. At some point, yield curve control will be implemented, and let's not forget last year when gold made its all-time highs, the 10 years were at, I think, point 0.4, point 0.5. So it was a big relative move in the 10 years, and I think that once we go into the direction of 1.8 to 2%, I think that there's gonna be quite a lot of important opinions coming out and research papers from the Federal Reserve and whatever,
Hmm.
saying that, well, at least temporarily, we will have to implement some sort of a yield curve control, which means that's basically quantitative easing without any limits.
Mhm.
So I think this is clearly going to be the next stage. We already had it after the Second World War.
Hmm.
This is a central tool of financial repression, and therefore, I mean, I agree there will be turmoil in bond markets at some point, but then I think it would be naive to think that the Federal Reserve will not step in. I think we will see some sort of yield curve control. Perhaps they will call it differently. They will come up with a new abbreviation that sounds
Mm.
really, really sophisticated. I mean, back then, quantitative easing, I mean, that sounded so smart and so academic. Yeah.
There, are you seeing a lot more gold buying in Germany? I mean, I read about it. I've seen some anecdotal comments on our Reddit community talking about Germans buying tons of, lots of gold right now. Is that something that people are talking
Hmm.
about?
Absolutely. I mean, Jim, last year at exactly the same time, we published a special report on inflation. It was called Inflation and the Boy Who Cried Wolf. Back then, CPI for the US was at 1.2%. Now we're at almost 7%. So I think what really changed over the last year, inflation is a topic again. Of course, central bankers keep telling us, well, it's only transitory. It will come down. It's
It's a hump.
supply disruptions and so on.
Madame
Yeah,
Lagarde
it's
called it a hump.
yeah.
It's not transitory. It's a hump.
I love that. Yeah, um, especially with her accent. It's a ump. Uh, but
That doesn't sound as
that.
sophisticated. That didn't come from the ivory
Yeah.
tower. Yeah, it's not too. I expect more
Yeah.
sophistication from her.
But the thing is, inflation really is a topic again. So if you talk to people, especially people having a proper job and not something in financial markets, they start talking about inflation right away, while people in
Hmm.
the financial markets industry, they say, well, they kind of believe the transitory fairy tale. Um, in Germany, we saw over the last couple of months enormous physical demand, so significantly more than through the euro crisis, where people were actually lining up on the streets. So it is something. It is really becoming a big topic again, and I tweeted out a couple of charts this morning. Wholesale energy prices in Germany, which is, of course, their industry is not the least important part of the economy, I would say, and energy prices are just going through the roof. So it will trickle down to producer prices. It will trickle down to consumer prices. So I think, the big question, of course, is, and this is a question that people ask me all the time, inflation now is a big topic. What the hell is going on with gold? So many people over here are kind of frustrated, people that don't get gold. I think they're a bit nervous. People that understand gold and accumulated gold over the last couple of years, they just say, well, it's a great buying opportunity. But I sense that many people are a bit nervous, and they don't understand why gold doesn't perform as it should be performing.
I'm nervous too. Why isn't it performing? I mean, do you have a theory? Why isn't gold at 2,500 right now? I would think what's Eurozone PPI? 16% right now, and our own fake PPI is what, 9.8%, which I'm sure is manipulated down. It's probably higher, but why isn't gold 2,500 right now? I mean, that's what I hear on Reddit all the time or on Twitter.
A couple of things that I think we should put it into context. Well, first of all, gold was up almost 19% in 2019, and it was up 25% in 2020. Since the beginning of the year, in dollar terms, gold is down 6%, but of course we saw quite some strength in the US dollar. In euro terms, for example, gold was up 21% in 2019 and up 15% last year, and it is up 2% year to date in euro terms. So of course, it's first of all it's the strength of the dollar is one driver. Then the second driver is, I think, you remember in 2019, May 2019, gold was trading at 1,300. So only 2.5 years ago, we are now trading at almost 1,800. We were up at new all-time highs. So that was quite a big move, and I think this move has to be digested. The third thing is, I think that institutional demand and from my point of view, this is really the marginal buyer. We don't really see any institutional demand coming in. So if you have a look at ETF demand, which is very, very pro-cyclical, it's basically non-existent. We've got big outflows from the ETFs, actually the biggest since 2013. So this is another driver. And then I think gold is very, very sensitive to expected long-term real interest rates. And at the moment, I think the market priced, the market is discounting inflation for the short term. Yes, it is seen as a concern, but it is not seen as a longer term topic. So on the longer end of the curve, I think that the market still believes this transitory theory. At some point, this will end, of course, but at the moment, if you have a look at inflation rates discounted furthermore ahead, it is not a concern yet.
Yeah, I think you have a good point there. It is a consolidation. Gold here, I'll bring up the monthly chart like you just said. This is the monthly chart. Each bar represents 1 month going back. And if you look at it from a monthly chart, I don't know, that doesn't look that bad to me, does it? It's had this great move since 2019, and it's just sort of consolidating and holding up. And isn't it true? A lot of people are saying gold sniffed out this inflation early. Gold sniffed out the inflation that was coming back here, and then it happened. It's only just now showing up in the numbers, but gold's the leading indicator. So what is that? Is that, do you subscribe to that theory?
Yeah, we once called it, I did a keynote on that. I think I called it the seventh sense of financial markets. And I think that gold very, very early on discounted this uh, monetary madness and all the fiscal stimulus that was coming. And if you have a look at those weeks, spring last year, actually gold initially it was sold off during the market panic, but then it was the first to bottom. And I always said it's first gold, then silver follows, then the broader commodity markets, energy markets, and at the very end, it's for example agricultural commodities. And I think that played out really well. And from my point of view, perhaps gold is already. Perhaps it's already sniffing out now, or it starts sniffing out the policy error that the Federal Reserve is going to make. But perhaps, I mean, I have to correct myself. Probably the policy mistake has already been made with the Fed basically waiting way too long.
Yeah.
And we know that they're way behind the curve. So now Powell coming into the inflation camp, I think that's it's pretty interesting now that the market, at least for the shorter term, has priced in more deflation or more of a disinflation. Let's put it that way. So the last couple of weeks were actually quite a deflationary move in markets, and I think that the Federal Reserve knows that they're pretty much trapped, and that there's no good way out. And I've got it here, this brilliant quote by Ludwig von Mises saying, "There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the results of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved." And that sums it up pretty well. And I think that Jay Powell probably knows and understands that. So it's going to be a very, very interesting year going forward.